welcome to this edition of My Two Cents. My name is Lon Broske. I'm a certified financial planner with Pines Wealth Management in St. Louis, and my goal in doing these videos is very simple. I want to help educate investors. I firmly believe that an educated investor makes for a better investor who makes more intelligent decisions, which ultimately helps keep them on track with their financial goals. Well, I want to talk about two very important concepts this week: proactive versus reactive. And it's very important for the long-term patient, goal-focused, planning-driven investor to know the differences between the two. Because over the last 5+ months, where volatility has been extremely high and investors have had a high amount of anxiety, these two terms often get confused in the press. One is a knee-jerk emotional response to short-term events and doesn't belong in your financial plan. And the other is a measured, educated, intelligent approach that analyzes the effects on your financial plan and also your investments from short-term events. And it's unemotional and can help you in your financial plan. One gets you closer to your financial goals. The other actually gets you further away from your financial goals. So it's important for investors to know the difference between the two. Well, let's talk about being reactive. Being reactive is, I understand that with investors. It's a common emotional response to fear and to panic. And it's that financial press doesn't help the investor in times of fear and panic. In fact, I would argue that they actually help them by encouraging the investor to be reactive. From February 19th to March 23rd, the S&P 500 dropped 34% in 33 days, which at the time was the biggest drop in the shortest amount of time and was a height of the COVID-19 panic. We hadn't yet understood COVID-19 and the impacts on the economy or the impacts on us as a society. And so at that fear, or at the height of that fear, you had the financial media through websites, through newspapers, through financial shows on financial channels, telling us to react, encouraging us to react through the headlines. You saw headlines like "Money Moves to Make Now," or you saw the financial channels scramble to get shows on in prime time that specifically focused on reactions that you should be taking right now, or moves that you should be making right now to help you through this crisis. Those are reactive types of things they were encouraging you to do. So a knee-jerk response, an emotional knee-jerk response to what was happening, to the uncertainty and the panic that was happening at the end of March. And it happens every crisis. 2008, 2009, which is the most recent crisis that everybody thinks of, there was all kinds of headlines in the newspapers and on the websites and all kinds of financial shows that were in response to what was happening during the crisis. A reactive type of response to the uncertainty and actually getting you farther away from your financial goals. Because the author of these articles, they don't care whether or not you get closer to your financial goals or not. Their whole goal in wanting you to be reactive is invoking that reactive emotion in you, is to keep you glued to that article, to keep you glued to that television, because that's how revenue is generated. And if you're glued, they have you hooked emotionally into these articles, into these websites, into these shows, then they're doing their job. Not caring whether or not they're getting you closer to your goals or actually farther from. They don't care. They just want you to be emotionally invested in what they're selling. Well, a proactive investor is just the exact opposite. A proactive investor takes a measured, educational, intelligent approach to uncertainty, to downturns, and to fear and to panic. Because the proactive investor understands that the emotions involved during drawdowns, during fear, and during panic are not necessarily relevant to your goals. They don't help towards your goals. The proactive investor understands that. How do you become a proactive investor? You do your research, you do your homework before a drawdown, before a crisis, before fear and before panic happen. You understand how your investments are going to react in good times. You understand how your investments are going to react in bad times. You've done the research already. You've done your financial plan. Additionally, you understand the risk levels that you're taking in your particular portfolio, and you evaluate those various risk levels. Doing the homework before is being proactive. And the advantage of doing that is that in times of fear and panic, you take the absolute correct response, a non-emotional response, because you've already done the research and the homework. And a proactive investor also uses history as a guideline, not headlines. The reactive investor uses the headlines as their guidelines, not realizing, understanding that reactive response to the crisis, to the downturn, is not the correct response. It can actually get you further away from your goals. Now, does being a proactive investor mean that you are idle whenever a downturn happens? Whenever a fear and panic strike? The proactive investor sits idle, sits on their hands, does nothing? Absolutely not. The proactive investor understands that in that moment of panic, in that moment of drawdown, the proactive investor could potentially alter or change their target allocation and take advantage of the environment that the drawdown has created. Give an example. Perhaps maybe you wanted to reallocate or in your target asset allocation plan, you have a certain percentage of your investments allocated to small size companies. But 6 months ago, when you were going through your target allocation and developing it and implementing it, small size companies were very expensive. And so you forego investing in that particular asset class. Well, now the drawdown has given us an environment to where we can reinvest in that asset class per our target allocation, which fits in our financial plan. It has nothing to do with the emotion of the moment. It's not a function of emotion. It's a function of our financial plan and staying on target with our allocation within our investments. That's what rebalancing is. The other opportunity that you might see in a drawdown that the proactive investor might utilize is to reevaluate their risk levels. Perhaps maybe they weren't in the right investments to begin with because their risk levels, they didn't understand them fully. Well, in drawdowns, that's an opportunity for you to understand exactly what your risk levels are. So the proactive investor reevaluates his risk levels and understands whether or not those risk levels are working for their financial goals or against their financial goals. So take the opportunity to the proactive investor takes that opportunity to do that, to reevaluate their target allocations, make sure they're on track with their financial plan, and to reevaluate risk levels and to take advantage of opportunities that the drawdowns have given them. So being a patient, long-term, goal-focused, planning-driven investor knows the differences between proactive and reactive. One could potentially damage your goals, could put you further away by being reactive, whereas being proactive is a measured, intelligent approach to crisis. And we will have another crisis at some point in time. I don't know what's going to cause it. I don't know how long it's going to last. I don't know when it's going to happen. I just know that there's going to be another crisis. And when it happens, the proactive investor knows what the impact is going to be and takes an unemotional response towards the fear, towards the panic, and helps them stay on track with their goals. As always, thank you for taking the time to watch these videos. You can follow us on Facebook, Twitter, or LinkedIn. Visit us on our website for more information at www.pineswealth.com. You can also make an appointment there as well. Stay safe, stay healthy. Thanks for tuning in, and we'll see you next time.